Good afternoon, everyone, and thanks for joining our second quarter market thoughts. We've got a lot of detail to cover in the next hour, so we'll kind of be brief with the intros. But I'm Philip Nelson, oversee the asset allocation team here at NEPC, and we'll briefly be covering our market outlook and then moderating questions once the presentations conclude. Joining us today is Melissa Mendenhall, who oversees and runs our private equity research team. Mark Santolo, who's our resident expert on interest rates within the firm. Andrew Brett, who runs our private real assets team. And then Kristen Colvin, who's one of the senior thought leaders on our defined contribution team, is going to talk about some of the ongoing and interesting trends that we're seeing in the DC space today. So just as a quick reminder, we are going to take questions, and we do want to take questions. So in top right of the webinar, there's an area for you to type in your questions, and we'll take those in and try to address as many as we can towards the end of the presentations. So with that, why don't we jump right in and get into the market outlook. This last quarter was, certainly a busy one where I think there's a lot of news flows going on, whether it was the Fed, trade concerns with China, ongoing geopolitical issues, tensions with Iran, and you kind of see that in how markets responded, where the U.S. dollar was higher, oil was higher, thinking about kind of risk assets outside the U.S., whether it's developed market, non-U.S., or especially emerging markets. Certainly felt the pain from some of the negative sentiment that arose from a lot of these issues. And so you definitely saw that for this last quarter, and to some degree continued into the beginning of this quarter. And I think one of the things we'll talk about is how much do we see this continuing, and does it fundamentally change any of our market views? One thing that kind of wanted to touch on before we got too far into things is just what's going on in terms of the yield curve. This is an important measure for investors, largely because when we look at the recessions that we've had since 1970, majority of them have been preceded by an inversion of the yield curve. And this is something that would expect from news headlines. Whether it's the investment community, there's going to be a lot of traction and discussion around the yield curve because right now we're around kind of 25 to 30 basis points of where the curve is today. And just from a quick definitional standpoint, what we mean by yield curve is the difference between the yield on the 10-year Treasury and the yield on the 2-year Treasury. So that differential between the 10-year, 2-year is the yield curve. And the reason why we're talking about this is, historically it's been a pretty strong signal in terms of recessions coming down on the horizon. It's not something that we are concerned about today because of where the curve is. But as we approach zero, our concern will dramatically escalate. And I think we wanted to kind of maybe spend a little time and kind of prep for our clients and kind of prep for folks that read our communications. What are some of the conditions that we're thinking about from an economic basis or financial basis that would cause us to turn materially bearish in our views? Right now, I think we could characterize ourselves as kind of moderately pro-risk in some of our views on equities and credit and other areas. But as the yield curve approaches zero, as we see other economic fundamentals and leading indicators maybe weaken, I think you would see us come out with what essentially would be a raise safe haven fixed income message that would be kind of dramatic in the sense of materially raise your kind of core fixed income exposures and reduce your equity exposures. And to be clear, that's not something we're talking about today at all, but we just want to be as transparent as possible in terms of what are some of the things that we're looking at and how could our message change over the next 6 to 9 months as maybe we see the yield curve march ever lower. And some of that ties into some of our key market themes. And I think 2 things that we'll focus on today is really the Fed and globalization backlash. And in regards to the Fed, our baseline assumption has been and continues to be that the Fed's going to move in a gradual approach in terms of how they tighten monetary policy and raise rates. And we've talked about globalization backlash last quarter. We're we're talking about it this quarter. My guess we'll talk about it next quarter as kind of the trade tensions with China probably will continue for a while. But sticking with the Fed, we've seen 2 rate hikes in 2018. That's was largely priced in. Markets are expecting maybe another 2 more hikes for the remainder of the year. And then as we look into 2019, expectations for a couple more hikes priced in for markets. So assuming these hikes occur, when we kind of dig into market expectations of the Fed funds kind of futures curves, we can see that for the most part, markets are expecting an additional hike in June of 2019. I think this is fairly consensus, not a surprise for folks, and somewhat reconciles with what the Fed has said is their kind of steady march to try to slowly normalize interest rates. But what's interesting is, assuming this occurs then, and we see an additional hike, what's the market telling us in the back half of 2019? And it's telling us the possibility of a cut coming out of the Federal Reserve. And I think no one is, discounting, expecting, or really talking about the prospects of a Fed funds rate cut, which would certainly be a surprise to the market, and it would certainly be a surprise to the Fed, since they're being fairly transparent in kind of the path of interest rates that they expect and how they expect to go. And so I think one of the things that's an issue of concern for us is, is there a disconnect between market expectations and what the Fed is telling us, which raises some concerns of how would that impact the yield curve, which we previously talked about. And then also when we think about the last 5+ years of the markets, it's been a relatively low vol environment, and part of that has been through transparency and kind of the expectations that we've seen in terms of how the Fed would behave. So if we start to see a disconnect in markets and the Fed, that clearly is a risk indicator for risk assets, but also probably raises the prospect of higher volatility in all asset classes. Because I think most would agree, financial markets like kind of benign, straightforward, transparent Fed actions. And if there's a disconnect and some confusion, that clearly is going to have an effect down the line back into 2019. And thinking about that, of kind of how the Fed's operating, we've seen interest rates rise by a fair amount in 2018. And you can see this in kind of the belly of the curve, where rates, especially at the 3-year and 5-year point, are up over 50 basis points relative to the start of the year. And so when we think about interest rates and where they are today, and kind of nominal, kind of core fixed income allocations, we're finding them reasonably more attractive. And so as we kind of approach the later end of an economic cycle, think about where we are in terms of the probabilities of some adverse economic events occurring, which we still think are relatively low from a tail risk perspective. But when you tie that in with higher interest rates, we think the value of fixed income is relatively higher today. And so one of the things we're encouraging folks is to raise some of their safe haven fixed income exposure. And it's simple as, rebalance from your equities to get back to target, or use, high yield credit as a possible funding source for, some of the kind of quote unquote safe fixed income instruments. One of the other major items in the quarter was U.S.-China trade relations. And I think there's too much to go through each line item of actions that have occurred, but we've been tracking, among others, kind of what are all the actions that have occurred through the year, and kind of the kind of relative tit for tat that we've seen between the U.S. and China in regards to trade policy. I think one substantive point that we've seen is, in early July, tariffs were placed on $36 billion worth of Chinese imports, and the Chinese responded with kind of an equal amount of tariffs, really focused on soybeans, and we'll get into that a little bit later with Andrew's presentation of real assets. But one thing that we do expect is, later in the quarter, the possibility of additional tariffs on $200 billion worth of goods, I think are fairly likely in terms of what we'd expect. Still, our baseline view is these tariffs have kind of a de minimis impact on kind of economic growth, but they do have an impact on sentiment. And that's one of the things that we've seen some of the negative sentiment for emerging markets in the last quarter. So one of the things we've tried to do is kind of highlight, what's our base case and what's our expectations for outcomes when it comes to, U.S.-China trade relations. So again, our base case is almost this pseudo Cold War that we could see between U.S. and China in terms of their trade relations, where tariffs continue for a prolonged period of time, and essentially, once all the tariffs are in place, kind of that becomes the status quo for a while. From economic impacts, we think it's relatively marginal. It's probably a few ticks of a point off global GDP, but it's not a material impact. And then inflation's probably marginally higher as well, just from the additional costs that flow through. But all things being equal, markets will discount valuations and fundamentals, and this will maybe be a more transitory issue as people get used to it. That being said, there is a favorable outcome, which is simply we have a negotiated settlement, and that's something that would have to be beneficial to both parties, both U.S. and China. So it's a little bit hard to see how that path would be weaved today, but it's still possible. And should we see that, that's probably going to unleash quite a bit of the kind of pent-up positive sentiment that exists in international markets and will be a big benefit to EM equities, we think, but not necessarily kind of our base case view. And then I think also it's good to highlight kind of what are some of the lower probability risks that we could see. And we do think these are tail risks and not ones that we expect to occur, but thinking about kind of a real full-blown trade war. And what we mean by that is, protectionism in terms of actual restrictions on goods flowing back and forth between countries, as opposed to just tariffs. Restrictions on supply chains, restrictions on how goods move back and forth. And you can think to, probably the only period that's of relevance that we've seen this is probably back in the 1930s, which is clearly kind of an ominous economic environment for some of the global trade restrictions we saw then. So that would be, should we see this type of market environment, one where, fixed income would likely be the dominant source, or even cash and, shorter-term fixed income would be kind of the place that folks would need to hide. It would be a painful event, but again, not one that we're expecting. So thinking about, outside of just the market backdrop, what are some of the current opportunities that we see in the market today? A few changes from last quarter, where we've been talking about having a positive view on TIPS. I think we still have a strategic positive view on TIPS, but when we think about TIPS pricing relative to nominal bonds, we think kind of the inflation differentials have been fully priced into markets. So our bias now is a bit to more the nominal bond side. So think core bonds, treasuries, high quality muni bonds, as being kind of a better option on the kind of the more safe haven fixed income side. And two areas that we're going to focus on today is in regards to U.S. equities, and then some of the fixed income discussions mentioned already. So on the U.S. equity side, there's a couple different valuation metrics that we look at, and some are frankly contradictory. One thing that we look at valuations and more longer-term cyclical valuations of U.S. equities, and we see that currently U.S. valuations are above average. But when we think about the extremes that we saw, frankly, this would have been in the late 1990s with technology stocks and the pets.com of the world, where valuations were at extreme bubble levels. We're very far away from that standpoint. So that is a data point that says markets can still run, especially on the U.S. equity side. But then when we look at profit margins are at kind of all-time high relative to their ranges since 1990s. And a lot of this is tech-driven, but still, profit margins are a cyclical indicator, and we're at cyclical highs today. And I think the other data point that we think about is, it's a relatively simple one, but market cap, the S&P 500 relative to GDP in the U.S. And you can see, that metric is again at its high back to the late 90s. So when we put this together, we think still there's a somewhat favorable economic backdrop that we think can support U.S. equities, but we think it's prudent based on some of the other valuation indicators to start trimming back some of the gains. And then last, hammer this point, probably a little too much at this point, just thinking about safe haven fixed income exposure and some of the options and how yields have changed over the the last 6 months in terms of what we're seeing. And like I've said, on average, we think they're marginally more attractive. So it would encourage folks on the margins to try to raise some of this quote-unquote safe haven fixed income exposure. And should we see some real negative metrics start to come down or the yield curve approach zero, be prepared to increase these by kind of a dramatic amount. So that concludes our the broad outlook on the market, and we'll transition over to the equity team, and Melissa's going to run through our outlook and views there.
Thanks. As previously alluded to, it was a mixed bag in equity markets for the second quarter. U.S. stocks increased for the quarter, supported by strong earnings growth, but the emerging market equities and currencies weakened at the same time. U.S. small cap outperformed large cap as tax reform benefits continued to boost earnings. On the other end of the spectrum, trade concerns and Chinese currency weakness weighed on emerging markets returns as equity markets neared bear market territory. This slide demonstrates some of this currency dynamic. So while China represents a small portion of the EM currency index, it has an outsized impact on emerging market sentiment and the broader basket of currencies. So you can see that that tick down in the last quarter. We've covered some of this ground already, but we continue to have the same sort of equity beta group actions for now. Trim U.S. equity gains use small caps as a preferred implementation for both non-U.S. and U.S. equities, and overweight small cap and consumer-focused EM strategies. One topic we wanted to draw your attention to is the changes that will take place with the structure of the GICS, or Global Industry Classification Standard. These changes were announced at the end of 2017, but they'll go into effect before our next quarterly call, and you'll see some changes in your portfolios as a result. The rationale behind the change is to reflect the dynamic business and technology environment, particularly the convergence between media and telecom companies and the changing nature of the retail industry as driven by e-commerce. One major change is that what was previously known as the telecommunications services sector is now going to be broadened and renamed communication services. So with this change, the sector will gain companies that were formerly classified as information technology companies, such as Alphabet, Facebook, Tencent, and Baidu. It will also gain companies that used to be in the consumer discretionary sector, such as Comcast, Disney, and Netflix. In addition, the consumer discretionary sector is changing so that will now include all online marketplaces for consumer products. So names such as eBay and Alibaba will move into the consumer discretionary from the information technology sector. So the classifications of these companies better align with their core businesses. This slide quantifies some of the relevant statistics related to these changes. So $3 trillion in market cap will be moving sectors, and the change will impact 6.7% of the MSCI ACWI. Around 200 companies globally will be changing sectors, and 125 from the MSCI ACWI will be changing. A number of these companies are also just very large holdings in the S&P 500, so 2 of the top 10, 3 of the top 10 in the MSCI ACWI, and 4 of the top 10 in the MSCI EM index. So still kind of staying on the subject of technology companies, but switching gears a little bit, I'm going to spend some time right now on one of our top themes of the year in private equity, which is European venture. And no discussion of venture would be complete without a page of logos, but what you might not realize about the logos on this page is that all of these companies originated in Europe. Europe's typically been perceived as a laggard in tech investing with pretty mediocre historical returns, but this has really begun to change more recently, as a significant number of companies have been exited or valued above $1 billion, having reached what we refer to, and you've probably become sort of part of the normal nomenclature, as unicorn status. We believe these companies really represent the tip of an emerging wave of European tech companies. And as some of these early European winners have been exited, a lot of the market skepticism has begun to dissipate, and the ecosystem for European venture has really been expanding. And it's building on these early successes in a few different ways. One is that tech investors and entrepreneurs who have made money in the space typically reinvest substantial amounts into the ecosystem in the form of angel and seed funding. This increases the number of startups being formed, as well as the overall talent base of the tech sector. It also results in more capital flowing into new ideas and business models, so there's just a lot more company creation. Employees of the early successful companies are themselves recycling back into the ecosystem. So some of them start new companies, drawing on their own experience, while others join young companies with early growth traction to help them reach scale. This type of experience and talent was really very hard to find for European startups. And as exits have materialized and successes are shared, an entrepreneurial career path is perceived as increasingly attractive and potentially highly rewarding. So younger younger talent that typically might have gone on to work for large companies are now actually starting their own. So as the European market has demonstrated its ability to produce larger companies and generate meaningful capital returns, investors have gained confidence in the market. As a result, capital has entered at all stages of the investment spectrum, and tech hubs have emerged in London, Berlin, Paris, and Stockholm. At the same time, while European ecosystem and venture landscape has developed substantially, it's still a lot less competitive than the U.S. So the amount of capital being raised for venture in Europe is a fraction of what's being raised in the U.S., and the same is true of deal activity, although it's on the rise. As a result, the entry valuations for early-stage companies are on average lower in Europe compared to their U.S. peers, and this valuation gap persists in the later stages. So while it's pretty even at the like the seed stage, as companies grow and start to attract further rounds, there's really just this huge valuation gap. I'll finish up by highlighting some ways to learn more about this if any of this has piqued your interest. So my colleague Brad Robotham recently wrote a market chatter piece after a trip to Europe where he visited with around 50 VCs in the market. And you can find this a link to this market chatter piece on the NEPC website or through this link when we send the presentation out. We also have a few funds we've underwritten that are open through the end of the year. Lakestar is a firm based in Zurich with additional offices in Berlin, London, and Hong Kong. They're in the market with their third fund targeting early-stage internet-based tech companies, and they're also raising a growth stage fund for larger, more developed companies and technologies. Additionally, if that's maybe a little too far out in the risk spectrum and you'd like to access the European venture opportunity through a fund of funds, LGT is raising a dedicated European venture fund, and they have a seeded portfolio so it mitigates some of the blind pool risk going with fund of funds. In our pipeline is Cherry Ventures 3, which is a seed and early stage firm based in Berlin. And I will say both Lakestar and Cherry were founded by individuals that were part of this early wave of European venture successes, and now they're contributing to the growing ecosystem in another capacity as venture investors. If you'd like to learn more about these funds, you can reach out to your consultant and we'd be happy to get these memos over to you. I'll turn it over to Mark now, who will cover credit.
Thanks. So the good news in credit is that yields are up a bit relative to Q1, with both treasury yields and credit spreads somewhat higher. One of the larger spread moves that we've highlighted here is in dollar-denominated emerging market debt, posted a negative 3.5% return as spreads increased by 62 basis points. Local currency EM debt also down over 10%, due in part to renewed dollar strength. The bad news in credit is that spreads remain low relative to historical medians, and risk remains somewhat elevated. So you're not being compensated for taking on a lot of these risks. Our beta group thoughts summarized on this slide here. We think credit's rich relative to fair value with limited upside. With bond prices relatively high, it's difficult to come up with a scenario where you earn an outsized return in a lot of credit segments. With higher leverage and duration higher, risks feel elevated, but the forward-looking return premium relative to safe haven fixed income appears small. We do think credit selection is important, which supports the role of active management. And lastly, EM local currency debt remains an opportunity, one of the only liquid asset categories we've identified as playing a role in today's market for return enhancement. In terms of our recommended beta group actions, we think it makes sense to get a little bit more defensive if you haven't already. You can reduce lower quality credit risk exposure, particularly from high yields and potentially bank loans, and maintain or add to safe haven fixed income, as Phil mentioned. So that includes treasuries, TIPS, core bonds, and possibly with investment grade collateralized loan obligations, which we'll discuss in a moment. So again, high yield credit spreads appear unattractive. Spreads across BB, single B, and triple C rated debt are all well below median. Any increase that took place that you can kind of see way off to the right-hand side is just tiny in the grand scheme of things. And even just a reversion to the mean would lead to a price adjustment that could wipe away your yield. An interesting potential trade we wanted to highlight here is the IG CLO opportunity. We think for a lot of clients this is going to be a quality trade. You can shift your average credit rating up without sacrificing too much yield potential. You can see on the left-hand side, BBB rated CLOs profile nicely alongside high yields, and bank loans from a yield perspective. And then over on the right-hand side, 2/3 of the way over or so, you see AAA rated CLOs actually yielding above the Barclays aggregate. So essentially, you're trading a pure credit spread exposure, which looks unattractive in today's market, and taking on a small liquidity, maybe a complexity premium that helps limit the give up in yield. We show the default history of CLOs at the bottom. Profiles very favorably, essentially no losses all the way down to AA, minimal losses out to the BBB rated tranche. On the EM debt side, here we're looking at 10-year real yields in EM countries in dark blue, and then 10-year real yields in the US in green. It's been a fairly persistent spread over the past 3 or 4 years, but the real yield differential has grown a bit in recent months, from about 1.5% or so about a year ago to around 2% today. So it is marginally more attractive. On the chart to the right, we show the country allocations of the EM debt local index, first on a yield basis, and then second on as a percentage of the index. And then the last thing we wanted to highlight, some of the ideas our research team has been looking at across niche lending, looking at IRR on the vertical axis and then the fund life period on the horizontal axis. US and European direct lending have been an area of focus for us for the past several years, but there are opportunities for return enhancement in some of these smaller segments like software lending, aircraft leasing, energy and infrastructure lending, to name a few. Lastly, just our latest asset category ratings. We've kept everything the same as Q1. Private credit, EM debt, local currency, and CLOs are the areas where we're most constructive. Andrew Brett will walk us through the landscape for real assets.
Maybe just a quick reminder for any folks that have questions, type them into the question box in the top right, and we'll get to them towards the end of the presentation.
Great, thanks. So this is a review of what happened in Q2 for the liquid real asset classes. In the top right, you can see select performance for these asset classes. Energy commodities led the way. You saw weakness in the industrials and the agricultural commodities that were really impacted by talks of tariffs, as Phil touched on, and we'll go into more detail in a few more slides. And you also saw a rebound in midstream. So midstream MLPs, an area that we've been constructive on for the past year or so, finally caught some good tailwinds as consolidation and simplification have helped this market catch up to what we think is a strong fundamental story. Of note, REITs had a strong quarter. So last quarter, we noted that there was about a 10% discount in valuations between REIT values and the private market values. That gap was closed this quarter. So that was something that we were monitoring. It was quickly gobbled up, and there were a few high-profile take-privates as well. In our thoughts and actions, we note that real estate asset appreciation is slowing, and we've had a focus on income growth as that asset appreciation slows. Last quarter, we highlighted Core Plus as a way to get some incremental yield out of your more safe haven real estate portfolio. We still think that's an opportunity. We aren't going to highlight it this quarter, but we're happy to talk to you if you have any interest in something like that. Opportunities persist in energy, private equity, and debt, and we also like the midstream energy and natural resource equity space. So we still like these areas. We'll go into a little bit more detail there, but we do note that geopolitical and trade tensions are impacting a number of these sectors and really creating a lot of uncertainty in a lot of the asset classes we cover. As it relates to energy, so we noted a couple slides ago that oil prices are up 14% on the quarter. You've seen asset values really rebound. What's gone on is OPEC's really complied with the cuts they instituted last year, and U.S. market share has grown as a result of those cuts. As prices have rebounded, more wells have gone online in the U.S., and you've seen the U.S.'s percentage of overall production really increase. So as prices have trended upward, it's given a little bit of pause to the Trump administration, who has publicly floated the idea of releasing some of the strategic petroleum reserves, but they also want to keep the USD weaker. So a stronger dollar is not good for oil prices, while a weak dollar is suggestive of higher oil prices. So those things are a little bit at odds with each other. But we do know that tensions with Iran are escalating. So the reinstatement of sanctions threatens Iran's ability to get their product to market. That's going to start in November, so you'll see some production come offline then. We've asked the Saudis to increase their production. It remains to be seen how much excess capacity they actually have. And the market's pretty tight right now, so we're just highlighting the fact that if something were to happen in the Strait of Hormuz, which accounts for about a third of the global petroleum trade on the sea, and that's that little strait in the Middle East that allows a lot of the oil from the Gulf of Mexico to get to market. So we're monitoring that. We don't think that's necessarily priced in. Should something like that happen, I think you'd see a quick pop in prices prior to any sort of resolution. Speaking of trade wars, Phil touched on sort of the timeline of the U.S. and China's tariff implementations. We are highlighting it here just to note that China and the U.S. have become very interdependent over the last 20 years. If you look at the top right-hand chart, not only do we still represent a significant amount of Chinese exports, but China has become a big consumer of things that we make here. And in the next slide, we're going to highlight the impact on the agricultural sector, but we'd also note that this creates a lot of uncertainty for the manufacturing and energy sector as well, and we're continuing to monitor that. The bottom two charts just show the breakout of the tariffs that were implemented initially, so the 25% tariffs. There have been a number of announcements since then, so this is not comprehensive, but we're just trying to key in on things that are starting to get implemented. And if you think about the agriculture sector, what's been in the news a lot, and yesterday there was an announcement that there's going to be a relief bill for soy farmers. So when thinking about what's going on in the soy market and how that impacts farmland and some of the funds that we like there, we just note that there's a lot of uncertainty from this. We export quite a bit of soy to China. We are the second largest exporter of soy in the world. As you can see in the bottom right-hand chart, when the Chinese tariffs were announced, soy futures crashed. And so it's expected that our soy production next year and pricing is going to be pretty weak relative to what we've experienced in recent years. Now, that announcement yesterday in terms of how they're going to implement the farm relief package remains to be seen. It's supposed to take effect in September. We'll continue to monitor this. As I mentioned, this creates uncertainty. We do have a sort of a value-add private equity strategy focused on this space in the U.S. We think if this creates a prolonged sort of stressed environment, that would create a good buying opportunity, but we're continuing to monitor it. And so finally, this is our summary in terms of our beta group trends. Nothing's really changed. As I mentioned before, we continue to like the energy space. We still think there's a lot of opportunity there, and we have some funds on both the equity and the debt side. We've got a number of non-core funds that we like on the real estate side. So if you have any questions, please feel free to contact me or a member of our team. With that, I'll pass it on to Kristen.
Awesome. Thanks, Andrew. So my name is Kristen Colvin, and I'm a principal on the DC team here at NEPC. And our team is one of the largest dedicated DC teams in the country. And I would say that whether you are listening today as a DC plan sponsor and one of our clients, or just as a member of a DC plan, the key theme of my comments today does apply to both audiences. And that theme really is that the DC market is at an inflection point. Here's what we shared with our DC clients at the beginning of this year. As you can see at the top of this page, it's been a great market for DC plans and DC plan participants. We're now in the 9th year of a bull market, and DC balances are the highest that they've ever been, so really a good time for DC participants and DC plans in general. Target date funds in the middle are the cornerstone of most DC plans, and a lot of plan sponsors are taking steps to address and implement other plan features. But what I'd like to call your attention to is in the bottom left-hand side of this page. When we asked plans at the beginning of the year, what's next? You'll notice that it's not a continuation of the fee conversation. That's a conversation that we've been having with clients for a long time, and fees have largely been addressed. Looking forward, it's improving retirement readiness and providing help to participants. So the reality is that we've built really good DC plans. We have great investment options, really low fees, but the problem is that the majority of DC plan participants are doing it wrong. And this is the inflection point that I referenced. What comes next for DC plans is a lot more emphasis on providing help and improving retirement readiness. And the reason for that is because there's broad recognition that there's no such thing as the average participant. Everyone is different and at different points on their retirement savings journey. And these differences range from retirement age and account balance to financial literacy and income levels, to gender, age, and pension benefits. And then, more recently, factors such as debt, outside wealth, behavior, life goals. These areas are becoming even bigger areas of differentiation among participants. So the next phase of DC plan design is making the plan really work for all participants, not just the average. So how do we do this? How do we meet participants where they are? We featured two ways at our recent client conference, financial wellness and retirement income. And I'll start with financial wellness. So financial wellness, if you're a DC plan sponsor and have attended or listened to any webcast on the DC market recently, safe to say that financial wellness is the topic du jour in the DC market today. It's essentially a term that's used to describe programs and tools aimed at helping employees improve their financial situation. I like to think about it in terms of if an individual has $1 to save, what should they do with that dollar? Should they put it towards saving, towards budgeting and financial planning to help pay down debt? And these are examples of what wellness programs can include. So savings help, financial planning, debt management. We think about savings, there's been a lot of headlines recently and actually, interestingly, some regulatory activity around helping individuals accumulate emergency savings. This is something that's really important, especially with younger savers. Financial planning is certainly relevant to everyone. Things like Social Security and healthcare planning are targeted for mid and late career employees, for example. And then finally, from a debt management perspective, no surprise, student loans here are a big topic of focus. You may have seen recently a headline about a large U.S. medical device maker that recently announced that any U.S. employee who contributes at least 2% of his or her salary to pay off their student loans will get a 5% 401k match. So this sponsor is matching loan repayments, not just retirement contributions. So a pretty innovative solution there. So we talked about this topic of financial wellness at our conference and got some indication of what our clients think. And the interesting thing is that 96%, not surprising, of conference attendees understand that technology is going to play a critical role in helping to meet participants where they are. 81% of our conference attendees acknowledge that they know how old millennials are, and that's important because they know millennials are in their plan today. I think when you think about millennials, they're often categorized and thought of as an emerging generation or as a generation that's coming, but the reality is that the millennials are here. They are 18 to 37 years old. They are the fastest growing population within DC plans, and they have vastly different investment perspectives and needs than the generations that came before them. So suffice to say that financial wellness is going to continue to be a trending topic and is going to play a big role in improving retirement readiness going forward. Another area of the DC market that is evolving is retirement income. And for those DC plan sponsors on the call, you know that the topic of retirement income is not new. It feels like it's been around forever, and it's historically been synonymous or defined as an in-plan guaranteed solution. And if I had to summarize the retirement income conversation in the DC market to date, I'd say it's really been a whole lot of talk, but not a lot of action. So only 8% of plans actually offer an in-plan lifetime income option. So decades of conversation, but very little uptake. So when I said that the DC market is at an inflection point, this is certainly an area where the DC industry can do better for participants and retirees. And our conference attendees largely agreed with that. So 80% of conference attendees believe that we should highlight different investment choices to participants of different ages. That's something that by and large doesn't happen today. And 73% of attendees are likely to encourage retired participants to stay in the DC plan. So when you're in retirement and using your DC plan as a source of distribution, it should be as easy to get money out of your DC plan as it is to get money out of an IRA. The reality is that's not happening today. It's much more challenging and much more restrictive to get money out of a DC program when you're a retiree. So making retirement income a reality in DC plans is something that we're excited about and that we're working towards. And for us, it really starts with broadening the definition of retirement income to include both products, and that can include guaranteed products, non-guaranteed products, but also more flexible distribution options. So what else are DC plan sponsors thinking about, asking about today as they think about improving retirement readiness? We're hearing a lot of interest in getting a ton of questions on ESG and impact investing. You may have seen the recent NEPC flash poll on the topic. Roth and Roth conversions have been a surprising yet very common area of interest among clients. This is really probably largely due to current income tax brackets and some interest there. And then also financial wellness continues, as I mentioned earlier, to be a very intriguing topic and specifically focused on apps that are available to help with wellness. And displayed on this page, starting from left to right, are materials that our team has developed to address all of these topics. So we have an ESG primer and a search book available, prepared materials and recommendations on Roth and Roth conversions, and a whole host of content on financial wellness, ranging from provider capabilities to actual profiles of commonly used apps to help improve financial wellness. So I'll end my prepared comments really with the same message that I opened with, and that is that the DC market is at an inflection point. It's not simply about great investments and low fees. It's about evaluating and implementing tools and features to meet people where they are and help them along their unique retirement journey. So with that, I will hand it over to Phil to wrap up and take questions.
Great. So we got a couple questions in, and you know, if you have any last minute questions, feel free to type them in, and we'll try to get to them if there's time. But maybe, you know, starting with Kristen, one of the questions that came in is, you know, I'm most interested in financial wellness and advice for plan participants. Who typically pays for that service?
Yeah, sure. So it can be paid for in a number of ways. First, the company can write a check to pay for the services as a benefit to plan participants. The plan can actually pay through revenue sharing or forfeitures, depending on plan rules, or you can charge participants for the services directly. I will say that there are also some non-monetary or non-costly financial wellness ideas that are implemented. So, for example, we have clients that has incorporated a financial booth next to the healthcare booth at their annual re-enrollment on site. So just thinking about ways to integrate the financial decisions into other decision-making processes that employees have to make in healthcare is a great example where you can sync the conversation together, and that really doesn't cost anything.
Great. Thank you. Kind of pivot to the energy sector. A quick question for Andrew. You know, why do we still favor energy given some of the recent price increases and you know, improved performance we've seen in this last quarter and this year?
Sure. Yeah, so, you know, even though the headline number for commodities is up something like 60% over the last year, and you've seen asset values increase that is commensurate with that, we still think there's opportunity, especially on the private side. Basically, there's two parts of the market we like. One's the upstream side, so the folks that own the leases to the acreage and invest in producing new oil and gas wells. A lot of the public companies have been hit over the head by the long-only community to spend within cash flow, so folks are not able to go borrow as much from the capital markets and really cannot be as competitive with new deals. And so that's both a source of deal flow, so for folks that are looking to sell assets, we think it's a good place to be in private hands, and it's also a chance to be a little bit more under the radar while the public companies are repairing their balance sheets. And then on the midstream side, so I mentioned earlier that MLPs and midstream have been really shellacked due to negative sentiment. There's still a need for investment in the infrastructure space. For example, the Permian Basin, which is the most prolific basin in the country, producers there are receiving $5 to $6 less for their barrel of oil than if you were in another part of the country. And the reason for that is it's capacity constrained. So they're not able to get their oil to market, and they have to pay up to do that. And so we think that there's opportunities sort of across the country to incrementally invest in the infrastructure side of the space as well.
Great. Thanks, Andrew. Another question came up in regards to some of the CLO discussion that Mark reviewed with us. Maybe for those that remember, 2008, how are, CLOs today or CLOs in general different than some of the more notorious asset-backed securities that failed in the last financial crisis?
Sure. So one thing I would say about that is to be clear, this is not a standalone recommendation to allocate to CLOs, particularly on the equity tranches. It's very focused on the upper echelon of CLO-rated tranches, which held up a little bit better in 2008 and 2009. And, we think that allocating away from sub-investment grade high yield or bank loans and moving toward investment grade CLOs, it gives you a nice balance of maintaining some yield in the portfolio, but moving toward a better risk-return trade-off. That being said, we would not be comfortable with IG CLOs as the only, safer fixed income asset in the portfolio because they aren't treasuries or cash. But for a diversified investor, we think it could make sense on the margin. Great.
And last question before we wrap up, for Melissa, in regards to venture capital investing. Do we typically see U.S. VCs ever invest in Europe?
Not really, not from the U.S. So early stage venture investing is a really high touch model, and so most U.S. VCs wouldn't really be able to spend the amount of time necessary with entrepreneurs and companies from that distance. A lot of U.S. venture firms have opened up offices in Europe, and we really do those now as European investors. I will say in the later stages, you will sometimes see the U.S. growth equity firms invest in European companies, and I think a lot of the entrepreneurs in Europe see that as a great way to kind of tap the U.S. or other markets. But really, you don't see that much in the early stages.
Great, and I can say as a market environment that has a little more difficulty in finding kind of interesting and good opportunities. This is something that Melissa's team's done a great job on trying to find some interesting ideas in regards to some of the European VC stuff that's come up, and kind of expect more to come. So with that, no more questions. So we'll wrap up. So thank you everybody for joining us. Hopefully it's a more quiet quarter than we saw last. But nevertheless, we'll be back in early October for the third quarter market thoughts, and hope to see you then. Thank you, everybody.